Okay, thank you, Annie. Welcome in, everybody, and welcome in for this afternoon CPD. I know some of you guys are going to be probably here for the whole day, so probably from morning and now. And if you're going to be joining us in the evening after dinner later, I will be the one taking you through things as well. Okay, so my name is Cheryl. Good to have everybody here. So we have about 350 people in this room. All right. So rather large class, but let's still keep it informal between us. So of course, like myself, I am agent like you, but of course, a lot of time I'm also devoting my time to training. So I do quite a number of CPD courses and as well as the RES courses. All right. But same drill, I'm like you, you're like me. So let's keep it informal. And most importantly, is for us to learn something by the time the lesson ends. All right. So if you have any questions, feel free to bring it up. If you want to unmute yourself to speak, feel free as well. All right. Otherwise, you can just type it into the chat, which all of you are doing greetings right now. All right. So good afternoon again, everybody. So we are going to get started. This afternoon, we'll be doing our professional competency course. And I'm still using this word here because we are still in the 2025 cycle. But before we go properly into today's lesson, maybe time for us to give you a bit of update in case you're hiding under the rocks. Now, maybe by now you all should know our cycle for this year is a bit unique because we have actually pushed backwards the expiration date to 31st of December this year. So to be exact, you will need to fulfill all our requirements by the year end. Unlike usual cycles whereby we are going to be needing to fulfill everything before 30th of September, right? So now there's a bit of extension. But the main problem is this. Next year come 2026, we are going to start off the cycle with on the 1st January. And with that, you will see that a lot of our CPD courses are going to change. And most importantly, how is it going to affect you? Number one, you're going to have to fulfill more training hours. So 12 hours of what we call structured learning, which is in another words, professional competency. So it's something like what we are doing right now. And we are going to have to fulfill 4 self-directed learning hours. That one is going to be today's context known as generic competency. So the hours have increased, and that's not going to be the end because in case you have not heard yet, soon they're going to increase this after next year as well. All right. But nevertheless, the other major change is also, other than the hours, is also the structure of the courses. Now it is mandatory for us to input in a assessment component. So this time around, we're going to try this assessment component, and I hope you all will have fun with it because so far, feedback on the ground is that people learn better by me asking you questions, you see. So later on, please prepare maybe if you have a mobile phone or any other devices if you want to. I'll be giving you like QR codes and links and things like that for you to go in and complete your quizzes. So we are going to go through this process called formative assessment, which means that these so-called short quizzes will be provided to you progressively. All right. It is good because then you don't fall asleep and it doesn't get too mundane for you, right? So that's going to be what we are going to be trying out this afternoon in case you haven't tried out a newly approved CPD. Now, this one is one of the newest one, okay? Yes, this is a professional competency module, all right? And this afternoon, we are going to be talking about valuation. So anyway, just a bit of disclaimer first. Valuation topic today. We are not going to be talking too much about the technical valuations, but more importantly is to kind of contextualize to where you are coming from as real estate salespersons, valuation is relevant to you and how it affects your transactions, your work, etc. So looking at the background of how valuation forms, how it is going to affect your work. That's going to be more of how this course is anchored towards rather than the technical calculation. All right. So this is one. Now your quiz today, is it counted or not? I give it to you first now. All right. So even following next year, so far, there is no need to fulfill a passing rate yet. So far, this is what we know. But of course, I think it is good for us to take things with integrity, right? So you try your best, all right? I would like to keep quizzes compulsory. So I would really love to see, now we have 420 people, right? So 420 responses. Let's see whether or not we can achieve that, all right? So participate. I hope this is going to be a wonderful journey for you. Okay. So with that, let's begin then. Now, valuation. Why do we need to talk about valuation? As an introduction first, valuation here is an important figure, not just because it affects things like transaction, not only transaction. Soon you're going to see many other authorities, many other practice within the industry is actually based on this so-called fair open market value. Now, valuation is often understood with the layman as what is the fair market value if people are willing parties transacting at arm's length. So in the most fairest condition, what is going to be the ideal value? This is what valuation is, all right, all about. And how is it important? That's more important for you. Now, many a times I do know we use market valuation as benchmarks. Not only us, right? For a good reason, our customers also use that as a benchmark. Some people depend on valuation to decide how much they want to price the properties. Some will decide how much they want to rent out at. And other things you're going to see is also going to be indicative figures, even for people like developers, so-called investors, right? Who are interested to purchase land property with the purpose of chasing after profits. So market valuation becomes then an important indicator because it tells us whether or not are we underpaying, are we overpaying? Is this a good deal or not? What's going to be the potential returns and things like that? So that's what we are going to be interested to talk more on. All right. So of course, as we move about, if you have interesting cases, please feel free to bring it upwards. Okay. Now, with this, a few theory first about valuation. Now, this one I'm going to kind of put on the hat of a valuer. So you are going to see, firstly, there are different kinds of valuer working for different parties. The outcome, the agenda might be a bit different because of the different positions. So example, if you're a valuer working for IRAS, your mindset is going to be a bit different. If I'm going to be a valuer working for a bank, my mindset is going to be a bit different. Same goes, you do have valuers for HDB as well. And of course, some of the private appraisers out there in the market, the agendas are generally different. So that's why sometimes valuation can sometimes be what we call subjective. How come you got three valuation report, but all three comes back with three different figures? That can help to explain why. But with that, by right, as long as we are talking about this module on valuation, these are some of the principles here. So firstly, valuation is going to be done the same way. Methodology may be different, but it's going to be conducted the same for these different kinds of property, regardless whether the property is actually for own stay, for example, if it is a residential property, or own use if this is a commercial property. It is going to be the same for vacant property or if such properties are actually generating income. So we're going to disregard what is the actual use of this property and rather conduct valuation based on a so-called fair platform. That's the first principle to start off with first. On top of that, you're going to see that valuation is looking at what is the existing value. So it is supposed to be looking at the existing condition, existing state to determine how much is today's valuation. So therefore, you must have heard this thing before. Valuation, you cannot take a figure that is 2 years ago, right? That's not going to be fair value. Obviously, because 2 years ago, things are different. Market situation is different. Condition is different. Probably the age of the property also different. So therefore, we are quite going to be obsessed about using data as close as possible to whatever we are today. So due to the fact that valuation is actually valued as at its existing state. Now, this one also takes into account things like statutory restrictions. Maybe in Singapore, we don't see a lot of these things, but in other countries, maybe you might have properties or land that is only earmarked for a certain group of people. Those things are statutory restriction. You cannot value those kind of property the same way as those in the open market. Let me explain to you how that can work here. So example, maybe some of y'all might have went for the consumer seminar for international properties recently held. Now, let's say it's, for example, New Zealand property. There are some land in New Zealand that is earmarked only for their Maori. which is their native people lah, by right. So there are some land that are only for that category of people. And if you are so-called not a Maori, you're not able to come in to buy this sort of land, you see. Now, these are what we call statutory restriction. So if you're going to be valuing that land that is purposely only earmarked for that group of people, it is not fair for us to take other properties, for example, in the Auckland CBD, to go and compare against such kinds of land, which is subjected to statutory restrictions. And let's talk about a story that is going to be closer to home, Malaysia. Now, Malaysia itself, there are also some sort like quota, some sort of a land that is only designated for certain category of people as well. Same goes, we need to take into account such statutory restrictions whenever we talk about valuation. So it may not be fair to say this is a 1,000 square feet of land and that's 1,000 square feet of land. And you compare these together, that's not going to be a fair deal because one is subjected to statutory restriction. Now, usually it goes like this. When there are statutory restrictions on such land, usually the value will be impacted negatively. Correct me if you disagree. But normally, when there are statutory restrictions on that land, usually the valuation will be impacted negatively just because you cannot sell it to open market, you see. So that's one. Now, of course, in Singapore's context, can I find you an example that we talk about statutory restrictions of property? Maybe I think the closest one that we have, it will be HDB rental blocks. So, example, if IRAS, for purpose of property tax, for example, decides to value what is this worth of this rental unit, they cannot compare a public rental flat to an open market rental, isn't it? Because such public rental flats are subjected to restriction, very strict criteria. So we all know that the rent that these tenants, so-called tenants, pay to HDB is very much subsidized also. So it's not going to be fair to look at those kind of comparison. Other than that, if you do have things like environmental factors, maybe again in Singapore, we don't see that very blatantly. But yes, if you do have some environmental factors that's going to be impacting one land more than the other land, we do need to take that into account. So, example, these days, maybe the closest I can find for you, is this one. You all know master plan is going to be revised very soon, right? So starting from 2026, we are going to see a brand new master plan known as Master Plan 2025. Now, one of the things that I recently just read an article somewhere, they are kind of putting the Kallang District Park redevelopment into a little bit of a hole first, because I'm hearing there's something about clearing of the land and things like that. Now, I'm just imagining it could be because of the olden days, whereby there are some industrial activities on that piece of land. Sometimes it can result in things like soil contamination. So it may not be so-called safe for human habitation. It could be things like that. So if your soil is contaminated, those are environmental factors, right? That piece of land is affected, other pieces of land are not affected. We do have to take into account. Obviously, that piece of land that is affected by the, let's say, it's the toxic soil, is going to be valued at a much lower valuation compared to other things, right? So that's what we mean by environmental factors. Okay. Now, cool question from Lawrence. Let's take that. How about ethnic quota, ethnic integration policy, right? That affects transaction prices at times. I agree with you. Actually, I think this is an absolute brilliant, can I say, input. Because yes, just looking at HDB, you got EIP quota, right? So there are also some news reports that have already surfaced that is saying that some of these EIP quota, because we need to subject ourselves to this restriction, especially some of the minor ethnic groups, perhaps in Singapore, maybe you might find that how come that kind of flat has to be sold at, kind of lower price, just because you have to sell to the same smaller minority group, you see. So with that, you got smaller number to play with, you got smaller market to start off with. Therefore, many a times our purchase price or selling price for those kind of units might be negatively impacted. That is absolutely right. So those kind of things, you can understand that as statutory restrictions. I would think this is a good example. But however, do we really take that into account when it comes to HDB valuation? To me, based on experience on the ground, I don't think so, right? I don't think it's like a big difference when it comes to different ethnic group. They don't see it that way. So therefore, you might see, for example, the valuation for a house, for let's say it's a HDB, that might be not so restricted by EIP quota. The valuation is 500K. Same goes for the house that is owned by perhaps a ethnic minority, also 500K. But the one that is open for more buyers might be able to sell COV above valuation. But the one that is with the minor ethnic group might have to sell under value, something like that. So that can be some differences in terms of the actual transaction price. But if you talk about valuation, they don't take that into account. Not that I know of, because it does seem that the valuation quite consistent as long as they are within the same locality, same block, probably equivalent, levels and things like that. So that's the little input for discussion. Good ones. Now, how about plot ratio, right? Does plot ratio is also going to be considered when it talks about valuation for sure, especially when you talk about things like land. We might not see this in terms of a singular property, example, condominium. So if you might not be able to see a difference blatantly like this if you're talking about a valuation of one condominium within the land. But however, if you're going to be talking about valuing the whole land, for example, for en bloc or maybe for government land sale, plot ratio for sure plays a part because plot ratio determines density. It's going to determine things like, how much is the worth of the land, how much can be built on it, the gross floor areas, etc. Moving forward, amenities, for sure. Amenities, we don't really call that environmental factors, but in a way, you can understand that as the surrounding factors. Factors that are affecting the location or the convenience of the location, for sure. This one is that one we know. Lah. Amenities, for sure, is going to be taken into account when it comes to valuation. But here comes the subjectiveness. Example, it's quite clear to us. One unit near the MRT, walking distance. The other unit is one station away from the MRT station, one bus stop away from the MRT station. The one that is walking distance surely will be valued more, for sure. That one we know. But the difficulty is this. If I have an enclave of blocks that is maybe within 500 meters from the MRT station, but one block is right next to it. The other one need to walk 2 block, 3 block away. That can be the subjectivity. So by right, technically, there should be some reflections of the differences in value by right because of the differences here. But how large is the difference? That is something that is subjective. So it does depend on who is doing the valuation. If it is the government, be very sure they surely have got some parameter. So example, they might say, if everything is within the 500 click, then maybe they will say there's no difference. This is like a standard guideline they will operate internally. Or perhaps they will say maybe one level difference minus away $5,000 or $15,000. That is up to the different corporations to see what's their internal parameter and guidelines. Okay. So anyway, you all are seeing LMA's admin's message as well, right? We're going to take photos soon, so make sure your faces are fully visible as we continue to talk, okay? Now, this is one. Now, other than that, we would say properties are all heterogeneous. So we say no two properties are exactly the same. Even if you talk about HDB flats, although they look very similar, but they are not the same. So therefore, this is a very important principle that each and every single piece of land, plots of land or houses needs to be valued independently and individually. Taking into account by right, theoretically, should be the condition, should be the stage, could be things like, tenure, etc. And lastly, this is something that I think we are all comfortable with. Valuation must be recent for sure. So how recent is recent? It's not the law, but there is a certain ballpark that we use in the industry. So we often say plus minus 3 months. So the if you have got as recent database, use the most recent one. But if you have no choice, then we should not use any data that is more than 3 months old. This is generally something I believe all of us are kind of doing on the ground as well. So much valuation, but rather when you want to advise your seller, how much is the selling price? You also look at past transaction, right? But you look at past transaction, you also don't look at 2 years ago. What? So it shouldn't be so dated. If it is that dated, you have no choice, then maybe you will have to make the necessary guesswork, right? How much would it be then so-called price at today? Okay. So that's a valid question. If you got no transactions in the past 1 year, how? If you're just talking about the shoes of a salesperson, let's say it's kind of a generic property, such as a residential unit. If there are no transactions in the past 1 year, that's a possibility. Maybe look at other nearby projects that can tell us a bit of a benchmark. Secondly, if you really don't have, the last one is 1 year ago, then we'll have to kind of second guess. It's kind of like testing the market again. Because I'm quite sure 1 year ago prices is not going to be what it is today. Maybe higher, maybe lower, but it then becomes something like a test market sort of figure that you put up onto your platforms, right? So that is the general idea, and that can be the difficulty. Now, obviously, if I'm going to be putting on the hat of the valuer then, so by right, valuers will behave this way. If I really don't have good comparison data, because maybe they are transacted so many years ago, maybe they might consider using, you know, uh, other methods lah, such as what? Later on, you will see that, such as cost method. They can also use other methods like residual method. Those things are different methodologies to help to derive at the figure. But obviously, unless you have an appraiser license, otherwise, whatever we do is actually just kind of like ballpark in a way, right? So therefore, it is important. If your client is really asking you, I want to know the valuation of my property. That's not something that we can answer, by the way. Then that's when you need to hire a valuer. Yeah, maybe two, three valuers. Sellers, you'd like to take the highest, right? Obviously, to price the product. That's for sure. Okay. So that is understood because those are like human behavior, like that's understood. But the thing is, if really people are asking us for valuation report or maybe the valuation, that's not something that we can answer. Whatever we are doing, such as comparing to the last few transaction, is just pricing. We are doing pricing. We are not doing valuation. Although there are some relationship between these two, which you're going to see later on. Okay. Now, side question a bit. Uh, so will you recommend an independent valuer to do valuation before setting the asking price? I wouldn't say I recommend or not, but it does depend on what kind of property. Example, if these properties are quite unique, for example, shop house, for example, maybe landed properties, I think it's a good thing that we hire valuer first before looking at other past transaction, because the other past transaction may not be a very accurate representation of what this property is ultimately worth. You see, so for I would say for a more unique kind of property, yes, I think it's a good practice. But if you're talking about things like HDB, things like condominium, which is quite a lot of comparison data out there, usually people find that it is not necessary. And whatever was the past transaction is quite close to whatever we are happy with. Okay. So can you make reference to IRAS AV or not? Possible? Good one. IRAS's annual value is the valuation conducted by their valuers for purpose of taxation and things like that. So, I will have to say yes, maybe one of the ways you can try to understand, at least as a benchmark for us, might be to take into account IRA's annual value, which you can find, right, actually, for that particular property. Okay. So, good contribution also. So how do you gauge those new property going to MOP soon, right? But you don't have any transactions yet because not yet MOP. How? That's the difficulty. I agree. A lot of time, I will have to say, we try our best to see whether, nearby vicinity, you got other newly MOP projects like that. Based on that, or maybe even older property got no choice. Sometimes older HDB, but within the same locality, you might have to make the necessary adjustment. But once again, I'll have to say, for like new properties like this, it could be a new condo also in a new estate. We don't have much comparison. How? Really, the safest way if we are interested to know what is valuation is to get the valuers in. But the valuers, same thing, they're also going to look at what they can possibly find in the market, and then they will make adjustments accordingly, like that. So as to how much is the adjustment, if you talk about us as agent, you want to do pricing, right? A lot of time you might want to just test the market a little. From there, you have the first few done deals, then that's when the ball gets rolling, right? That is the difficulty sometimes on the ground. So it's true, not everything you will be able to use this thing called comparison method. So there are other methodologies. You're going to see some of them later on, especially for valuers. If they don't have comparison data, they might choose to use other methodologies. Okay. So question, for landed valuation, are you referring to paid ones to check valuation first before comparing with the last transaction? For landed properties, it does depend. Like if your sellers is quite particular about the price and wanting to know what's the benchmark and things like that, we can suggest for them to get a valuer in to do appraisal first. Then, of course, with that, that's just like a report for us to take into reference, right? You can also use that together with the latest transaction data to kind of cross compare to decide what is the listing price ultimately. Okay. So, which are good third-party valuers to engage a reconstructed CCR landed terrace? Yeah, you see, so some of the very unique one. Go and check out SISV. SISV is the association for valuer in Singapore. We will be able to find some of the recommended firms, lah, right? So SISV is a big umbrella, it's like association. Maybe that they will have a list of, some of the recommended partners that they work with. I think that one is quite renowned, okay, quite a safe base for us. So bank valuation, I'm going to talk about that. You're going to see bank, of course, they got valuers also, but you will see that maybe the agenda is slightly different. You might find that the valuation report is a bit more fluid. So in a nutshell, those government related valuers usually is straightforward. This is the value full stop. But if you talk about commercial valuers, such as for banks, insurance valuers, or maybe other things like your private appraisers, basically they can be a bit more fluid, by the way, because they are not so bound by the regulations and things like that. Okay. So, is there a price range for valuation of different properties? Not safe to say that. It's not safe to say that. Just to have an idea, okay? So since for condo, we just go with the free ones from the bank. Maybe to us, that is good enough because you know why? A lot of time pricing, transaction price, the ultimate concluded price has got to do with whether or not the banks, we can lend money from the banks. So whether the banks can back up the valuation in order for us to obtain loan. So in most of the time, the banks are able, if we rely on that bank's valuation, it should serve you well for what you have to do. Lah. Okay, so this is I think a good one. Okay. Break, yes, lah, later on. We just started not long ago. Okay, so later on, 3 plus, we'll give you a break, don't worry. So anyway, let's move on slightly first. Hopefully, I'll be able to address some of your concerns as we move about. So don't worry. Let me know continuously if you all got questions, but we'll just move forward slowly first. Now, just to look into a different perspective, you are right. Who do valuation? Actually, many parties. It does depend on who is the party doing that valuation. Now, as buyers, sellers, some people might engage private valuers, right? If they need to, or if they want to, they might be the person who wants to see the valuation report first before decide on the pricing. But yes, there are also other different entities such as banks, HDB loan, even CPF, by the way, and all these other authorities, which we'll spend time discussing this as we move about. Now, this one is something we're very comfortable with because valuation is important for the seller. Firstly, nobody wants to sell under value, right? As much as I can, I want to sell way above value. That might be a way for sellers to decide how to benchmark the selling price. However, for the buyer's point of view, of course, valuation is important, especially for things like CPF withdrawal, for things like bank loan, HDB loan, and things like that. This is because valuation affects all of these figures. So earlier, one of you said, is it safe for us to use bank valuation? I say yes, because usually these banks valuation, especially if you are talking about bank loan, they, this report is sufficient actually for them to back up the loan amount. So if we say 75% loan, for example, it will be 75% up to valuation. So if they can support the asking price equals to the valuation, that can generally serve the general purpose for the buyer and the sellers already. Now with this, we understand this concept called cash over valuation, and of course, what's purchasing under valuation, right? But more precisely, we're going to look into the behind the scene. How come in such circumstances will result in cash overvaluation? I think that's particularly the interesting topic, especially you talk about HDB loan. Now, this is because for financial institutions like the mortgagee, so it can be separated into either bank loan or HDB loan. Valuation is conducted by the banks because this is a form of risk assessment for them. It goes like this. I want to make sure that whatever I'm lending out right now, this property ultimately, if it runs into default, so the borrower never pay money later, if the banks I'm going to sell this, foreclose it and to force sell it later, I must make sure I'll be able to take back whatever I've lent out. So to them, it's more like a risk assessment as a baseline to determine whether or not this should be the amount they should be comfortable lending to this borrower. That's the agenda. Now, with this, you will also see banks' valuers are a bit more fluid. What do you mean by fluid? Have you ever had these circumstances? This one has got to do with the sequencing. Now, let's talk about private property. Private property works this way. Normally, we kind of get the in principle approval first, right? Then the bank say, okay, already. Then you go and issue OTP and then you go and sign an OTP. So in a way, we will be able to kind of know roughly here what might be the valuation. So have you ever had this situation? Maybe you call your banker's contacts, you say, okay, we are going to transact this unit ABCD, all right, at $1 million. The bank contact will ask you for the address, right, and the unit number, etc. With that, they will say, okay, I give a quick call. Okay, I give a quick call to my company first, like that. Then in this case, they might come back, they say, your asking price or maybe the ideally transacted price is 1 million, but they're telling you the valuation about 800 only, like that. Then they say, okay, never mind. I check again. Then they come back and then they tell you, okay, we match the valuation like that. Have you ever had some sort of similar stories? This is what I meant by fluid. Now, the bank's valuers, they are not looking for 100% correct answer. They're not looking for that. They're looking at whether or not whatever is the so-called fair market value, whether or not they can stomach the risk or not. So do they want to take up the risk or not? Full stop. So usually, if the valuation is really very far off from the about to be transacted price, sometimes the banks cannot do anything. They will say cannot match. So maybe you want to renegotiate. That's when we don't enter into OTP. That's when maybe we renegotiate again. But sometimes also, if the valuation is not that far away from whatever is the to be transacted price, they might choose to match the valuation. So in a way, they will do some amendment like that to the valuation reports on the back end in order to support the loan that will be granted ultimately to the borrowers. So that's what I meant by being a bit more fluid. Once again, the position of the bank's valuers is for risk assessment. Now, of course, HDBs assess this valuers also for risk assessment for sure, but you will see that they will be a lot more rigid. Correct me if you disagree. Okay, so I will have to say, HDB valuers no non-negotiable, what correct? So whatever report comes back, it is what it is. There's no way for us to kind of nego a bit here and there. And also, HDB, the procedure is very different. We're supposed to issue the OTP first, right? And then you sign the OTP. Your valuation is here, after OTP is issued. So this one is absolute one. So if the parties are not happy with the valuation report, sometimes that's when, the buyers walk away, then they forfeit the OTP, they don't end up signing the OTP. They forfeit the option fee, right? It could be this way. Can we do a revaluation or not? Then you have to restart the whole process, right? For HDB. So that will mean you don't exercise the current OTP, and then for later, then you go and reissue another OTP for the same flat, for the same purchaser, asking for another renewed valuation report. And we all know that this is going to be subjected to questioning, right, from HDB, possibly. So therefore, because of the different agendas and the positions of the different parties, you might see valuation can be a bit subjective. Now, good one. James says for bank loan, if let's say this bank cannot match the valuation, so they just say that we stick to valuation 800, no choice. In this case, I might go to another bank, right? So another bank might be able to fulfill my needs, you see. That's true. Because different banks, they will operate a bit differently. Their risk appetite and decisions are also going to be a bit different. Okay. So here is the first look. What do you mean by valuation sometimes can be a bit fluid, can be a bit subjective also, especially when it comes to commercial valuation. I meant private valuers. All right. So especially for that. So this is one of the important thing about valuation and why we need that. Definitely to support your loan. Now, other things, CPF. CPF is also going to be dependent on valuation. So how much we can withdraw from your OA to finance this residential property, for example, is going to be dependent on valuation as well. So for the general market, as long as you're below 55 years old, generally we say you can use up to 100% or 120% from your OA to finance your property purchase, residential property purchase, to valuation. So we say either based on valuation or purchase price, whichever is lower. So that valuation report is going to be important because that would that CPF is going to use that to determine how much money this person can ultimately use towards your property transaction. So maybe a bit technical stuff, just to kind of spin off a little from this topic here. 100% is if you're talking about HDB loan. So typically you will be able to pay off your entire HDB flat purchase price using fully CPF. Maybe not one shot, maybe over the years as you continue to withdraw your CPF to pay your installment, could be. 120% is for bank loan. Even HDB flat take bank loan, you can withdraw up to 120%. Once again, how come 120%? This extra 20% or this total 120%, you may not pay one shot, you may not withdraw one shot. But we all know a lot of us actually use our CPF to pay towards your monthly installment, right? To service your loan. So loan comes with interest, by the way. So yes, this amount from your CPF will be able to help with that progressively over the years. So these figures are also based on valuation in a nutshell. Okay, so this is CPF, mainly on the buyer's point of view first. Now let's just use an example of a HDB flat buyer's point of view to illustrate this once more. So it goes like this. Let's say the purchase price is 500K, valuation comes back 550. This is very good news, isn't it? Very happy, I'm sure your purchasers. You're purchasing below value like that. That will help us determine the loan. Now, we always say loan and CPF or this financial institution is always going to be based on valuation or purchase price, whichever is lower. So in this case, the purchase price is lower. We're going to use this amount. But the hotly contested topic is the COV one. So some HDB flat, and I think for the last few years, quite a number of HDB flat all would have COV, right? Now, why so? Purchase price in negotiated is 500K, but the valuation is only 450. That will mean if you talk about your loan, 75%, it will be based on 450, not 500. Valuation or purchase price, whichever is lower. Same goes for your CPF. If you want to withdraw the remaining from your CPF, you also cannot withdraw up to 500K can only withdraw up to valuation. The shortfall will then have no choice but to pay in cash already in this case. Okay. So therefore, this is why you have COV. Now, since we are on this topic of COV, okay, maybe let me just highlight this HDB's procedure slightly first. Now, firstly, why do we often see COV in HDB? Correct me if I'm wrong, but sometimes COV can also be private property, just not very common. For one, remember the procedure is different. Procedure is like that. You got the in principle approval first, and then you issue OTP, then you sign your OTP. This is for private property. So in a way, I kind of already know what I'm signing for before anything else occur. So the chances of the purchasers walking away later is slightly lower lah, because they already know what is the valuation, whether or not they are paying for a fair price. HDB is the one that often has got this COV, because when I am at OTP stage, in a way, I'm going in blindly, in a way, lah, not really, right? But you're comparing to past transaction. But sometimes the past transactions is not caught up with valuation, or rather, valuation cannot catch up with the transaction. Sometimes that happens. So with this, because my valuation report only comes in later, that can become problematic in a way. So that can result in COV. Okay. So I'm going to talk a little bit about stamp duty later as well, but hang on to the question slightly. I'm going to take that. But this is a buyer's perspective when it comes to HDB flat. Now, on the seller's perspective, most of the time, sellers are interested in the valuation mainly because of the selling price, because nobody wants to sell the unit at a low price, isn't it? But however, more seriously, why is this valuation also important for the seller's point of view? Firstly, has got something got to do with CPF refund. So especially if the sellers have used some parts of the purchase price of that house they were selling, funded by CPF, this is when they need to refund the CPF from the sales proceeds. So it goes like this. If the seller is selling the unit below market valuation, and for some reason ends up with insufficient proceed to refund to their own CPF, including accrued interest, the shortfall has to be paid in cash. This one is CPF policy. However, if the seller is selling at market value, but somehow still end up having insufficient proceeds to kind of refund to your own CPF, the shortfall is then negligible. Now, I do know commonly in the market, we seldom talk about this. It's a good thing because Singapore market so far has been rising. But there are some pockets of properties you all know out there, right? Surely they make negative sales proceeds. So some of them make losses, you see. So at the end of the day, if we are dealing with that kind of property, not a lot of time, but sometimes, you might have a situation whereby the sales proceeds is insufficient to uh you know refund to your CPF. That can become problematic. So let's take a look at this scenario. How and why that happens, for example. It says I bought this unit at 2011 for $700,000. The valuation at 2021, for whatever reason, is just 800K. But my selling price, for whatever reason, is a lot lower. So can you see the selling price is lower than the valuation determined by CPF? After I deduct all the loan, whatever CPF I need to refund, you realize that you have a shortfall. So whatever leftover will be back into your CPF, but there is a shortfall here, 150K. CPF policy says if you are selling below value and ends up with a shortfall, we need to top up with cash. So yes, this one we will need to highlight to your sellers if we are having these sort of cases. The other scenario is like this. If your purchase price last time was 700K, valuation, because maybe market crash these days, maybe that's when the valuation is low. That's why you have no choice but to sell at a lower price. After returning all the loan CPF, you also have a similar shortfall. But the difference now is you do not have to pay back your shortfall in cash because you're selling by valuation. So this is how it works, and something that we might need to highlight to your clients if we're facing any of such cases. Okay. Now, this is the first quiz. So let's try and warm you up a little. I'm going to give us about 10 minutes or so to complete the quiz because we got 400 plus people. So let's see whether or not we can end earlier by 10 minutes. In 10 minutes, uh, let's play by ear later. Okay. But with that, I am going to be getting you to do this quiz right now, either by scanning the QR code or if not, hang on, let me pull out the link for you as well. If not, you can copy this link in your chat. Yes, link is coming up. Okay, so please do so within the next 10 minutes or so. So now it's about 2:45. We're going to check back on you 2:55. I'll be on the back end, of course, monitoring the input and the responses. You're supposed to put in your name and your CA registration number for your quiz, by the way. So that will be captured. Okay. So that's one. All right. So of course, you've got questions, continue to ask. I will stick around and take them progressively as well. All right. So 2:55, we're going to check back on you. Okay, thank you very much for all your participation. I'll wait for another 1 minute to close off the survey. But okay, I'm seeing your feedback. The score portion not working. I just open it up. Sorry about that. Didn't enable that, but don't worry. Dry run first, okay? So it's fine. So anyway, I'm seeing all your answers already. I am going to be going through them together. All right, not to worry. Let's see uh why some answers are this way and that way. Okay. So in 1 minute's time, we're going to close off the quiz. All right, so let's get all your last submissions in already. Okay, let's come back, shall we? Very good. So we have 400 plus answers already. Those of you who are still taking time to submit, do it. All right. So it's okay while we are talking through things. So not to worry, this marks contribution is just a look at how we are performing. That's fine. But most importantly, I'm going to go through some of the answers because I am looking at some of your conversations right now. Very good. Thank you for those who help to reply and things like that. Very good. So anyway, let's get going and go through all the answers together then. So I guess this first one, not uh the first one is not so difficult, right? So most of us would have gotten this right. So who is potentially affected by valuation? We say all of these people, right? We've seen how this works earlier. As well as there's quite a number of you talking about this question, right? This is question two. So which of the following is going to be um dependent on valuation, is it? Okay, so here is the little bit of a discussion. Let's open this up for discussion. All right. So for sure, you all know HDBEs lah, for sure, right? This one, I think no dispute about this. However, stamp duty is something we haven't really talked about. All right. But anyway, yes, using this question, I'm just gonna tell you first, which some of you have already helped to answer. Stamp duty, including ABSD, including seller stamp duty, is going to be based on purchase price or selling price or valuation, whichever is higher. Tax is the other way. So let's just keep this in our pockets right now. So whenever we talk about loan or financing, it's always going to be price or valuation, whichever is lower. However, if you talk about tax, if there is a deviation between price and valuation, it will be whatever is higher. So yes, it's going to be dependent on valuation. Okay. Now you are also saying that the purchase price arguable, is it? Purchase price, why is it dependent on valuation? May not be like, direct. I wouldn't say maybe it's direct relationship, but many a times you do realize that purchasers, how much they decide to purchase this unit at, for example, is going to be quite likely dependent on valuation as well, right? So it's going to be based on things like what past transactions look like. It's going to be based on if there is a valuation report. They will also be mindful about how much to offer if they come to know of such valuation. That's my thinking process. But of course, open for discussion. All right. Okay, good. So if you're saying, but it is not dependent, it's not absolutely dependent, right? Okay, fine. It is just affected. Yes. So maybe let's get the learning points correct. I think that's the most important one. What might affect value? Maybe is the phrasing of the question, correct? So maybe we should rephrase it to what might affect valuation, things like that. Yeah, or maybe which of the following are affected by valuation? That's more likely the right approach, lah, right? Purchase price, we definitely say, I don't think it's going to be direct relationship, but yes, indirectly for sure, what they will be looking at valuation before they think about how much to offer and things like that. Okay. So most importantly is to get our learning process right, lah. Okay, so that's the more important thing that we hope to achieve for now. Other things, let's see. I think so far very good. Everybody seems to be quite okay with this also. Cash over valuation. This means the purchase price is higher than valuation. Correct. So that's why you are buying above value. That's why cash over valuation. Other than that, I guess this is also okay. Cash over valuation. Why is it cash only? Because you've seen CPF withdrawal can only withdraw up to valuation. Bank loan will also be able to lend us up to valuation only. So that shortfall in between has to be in cash. Okay. Now about valuation, I think this one also okay. It reflects open market value. Okay. So hopefully you'll have fun. All right. This is going to be, how CPDs will be conducted next time also. And most importantly, throughout our runs so far, I am getting quite positive responses from the ground, like from you guys. That quiz, you're quite like it. Let me know if you think otherwise. But anyway, you like it or not, no choice. Like CCA requires this portion. But as practitioner trainers like us, of course, I want to keep that interesting for you. And most importantly, rather than just fulfilling the requirement, we want to use the quiz segment to embed learning. Okay, so this is a first try. So totally today afternoon, we are going to be looking at 3 quizzes, by the way. Okay, so we're ready to go forward. Now we have seen some of the things that most of us should know, lah, right? Things like CPF, things like the mortgagee and things like that. But did you know property valuation is also very much talked about whenever we talk about regulatory frameworks or law, lah, in a way, legislations. A few people actually work quite closely with your valuations actually. IRAS, we all know for sure. IRAS takes care of all the stamp duty. This includes lease duty. Do you know it can also go on indirectly to affect things like GST, if GST is payable? Property tax also, yes, that's something that definitely we know of that. Another authority that is going to be quite, a lot of times using valuation is your SLA. So SLA/URA, some parts of it. But because today all the statutory charges, such as land betterment charge, are all collected under SLA, so perhaps URA is not that directly looking at valuation here also. Okay, so this is one. Okay, so let's move on. Earlier, you saw this question already, so I'm going to reiterate this point here. Whenever we talk about taxation, may it be stamp duty, ABSD, seller stamp duty, lease duty, any forms out there, it's going to be based on valuation or purchase price, whichever is higher. So it is important for us, especially for HDB flats, okay, that we take into account if there is any COV component, because you might need to redo calculation. Example, let's say this is condo, for example. For whatever reason, there is also some sort of a COV or maybe undervalued purchase occurring as well. So let's say this is a Singaporean second residential property. The purchase price is 1.2 million, but the valuation is 1.5. When we deal with stamp duty, which includes ABSD, it will be based on $1.5 million, whichever is higher. So it's going to be important for us to maybe recalculate some of these figures when you're doing your financial estimation, etc., to your clients. If maybe your valuation report comes in later and things like that. Another thing is this. On the other hand, even if this is an undervalued transaction, your purchase price will be then based on your ABSD and buyer stamp duty will be then based on purchase price. So the long and short, as a final reminder, is that if you have a deviation between price and valuation, for taxes is always going to be whichever is higher. Okay, so don't forget that to kind of recalculate this if need be. So slip track a bit. You're asking quiz, is it must do? As of today, no, not necessary, but with integrity, I will ask you all to do okay? Next year forward, when the full-fledged CPD requirements comes in, it is mandatory, okay? So this is one. Now, stamp duty. Next thing, it's property tax. Now, I know a lot of agents, we don't really need to talk about property tax because that's not part of transactional work, but good base value for a person who is a practitioner in the industry. Property tax, we all know, is taken care of by IRAS. And it is derived on two things. Just now, you'll tell me AV already, right? So you know this, very good. Annual value. So it's based on this value called annual value multiplied by the respective tax rates. So obviously, a lot of valuers are being housed in IRAS. They are obviously non-negotiable, right? So they are there to determine what is the best open fair market value for purpose of taxation. So with this, annual value is a very unique word. It is not the capital gain, it's not the capital value, but rather they are looking at what we call annual estimated rent. Okay. Now, this one is going to help us to benchmark. We can kind of use your AV, yes, if you are trying to value leasing. So, for example, you want to know how much should I be leasing out this unit at? Maybe one of the telltale signs that can help us with the benchmarking is your annual value. But however, because annual value is estimated annual rent, that is not your purchase price, you see. So earlier, one of y'all were contributing this input, right? Can we go and look at AV to determine how much is the valuation? Yes, for leasing. Rental. If you want to benchmark rental, yes, that's one avenue. But however, if you're talking about purchase price, may not be 100% useful or maybe not directly useful because that only tells us annual rent. That's the concept of AV, by the way. So anyway, for IRAS, the annual value is going to be derived based on methodologies of valuation. That's when things will get interesting because sometimes they will use comparison method, which is something that we are very used to, but many a times they might use other methods. So some of these methods we might not hear before, but we'll have a chance to kind of dabble a little bit with those methodologies later on. Other than that, tax rates, we all know that property tax for residential and non-residential will be different, right? This is number one. Secondly, there is also further concession for what? Owner-occupier properties. And I'm talking about residential properties. So in case we are not updated, just to update us during this point of time, for the residential component, over the last few years, if I'm not wrong, since 2022 until now, 2025, there were every year amendments. So every year, the property tax for owner-occupier rates and residential rates have been changing. So as of now, this year, 2025, in fact, there's a little bit of concession compared to the last few years, FYI. Okay. So question, is IRA's website calculator good enough to calculate property tax? Yes, very good contribution. Now, answer is yes. For us, remember, we are telling you all this basic foundation background, not for us to do valuation. So it's not for us to go and advise the client what is your property tax because that will be dependent on annual value. So what would be the best gauge for us to fulfill our fiduciary duty? Use the official sources, correct? So IRA's calculator is good. So question, same location, two units out of the many other rented out by PRC tenant. Would it affect the annual value of the owner occupier of the property tax? Uh, Possible. If you have got past transactions, especially consistent ones, that is sky high. Those kind of things can affect valuation. Now, I'm just going to try to introduce to you first, but we will have a better look at it when we talk about methodologies. This is comparison method. Let's say I have 5 transactions. And the first transaction, let's say the rent is 5,000. The second transaction, 5,005. And then the third one, maybe another 5,000. Then the two sky high ones, maybe 10,000, like that. Normally, what would happen would be they will take away the outliners. So they may, if it's just 2 unit out of 200 unit, that effect will not be seen. But however, if you say this is 180 units out of 200 units, then for sure that will be reflected in your valuation. Okay. So question, stamp duty is based on valuation, yes. And valuation will be IRA's valuation, yes. So they only do a valuation when they suspect that you're trying to avoid ABSD, is it? May not be. They are going to be looking at valuation um actually progressively. I would say it's an ongoing effort that the chief assessors sitting in IRA's office constantly they do keep such registry to house all the valuation and things like that. So it's not so much okay, maybe they will pick up the cases offhand like that only when they're investigating, possibly. In this case, it's not going to be tied to your bank indicative assessment, right? No. So bank's assessment is bank's assessment. IRAS's assessment is more for taxation purposes, billing purposes, and things like that. Okay. So, uh, okay. So this is one, property tax. Okay. Now, anyway, annual value is going to be based on hypothetically, if this property is to be rented out on an annual basis, how much would it collect as rent? Most importantly, to note, when we talk about annual value, we are talking about rent, not the purchase price, not capital gain also. And that is really excluding all the other movable portion. So we are only talking about the immovable property component. That is in a way the fairest way to look at property valuation. Because I do know sometimes, in the rental market, we might be renting out more than the annual value. Why? Because sometimes your rent includes furniture. So sometimes it's fully furnished, partially furnished, and things like that. Could be. So therefore, you might see this as the very beginning. Price and valuation might be different for various reasons. So they are hardly the same, or sometimes it's not unusual that it is different. Why? Because of some of these considerations behind the scenes as well. Okay. So this is one. Now, question, how is annual value calculated? Is it monthly average rent multiplied by 12 months? Okay, the rent portion is based on valuation. So they compare it normally by comparison method, then multiply by 12 months, yes. But it can be the comparison after looking at the comparison rates, or it could be the actual rates, whichever is higher. All right, but it is not so correct to say it is an average monthly rent. Okay, so this is one. Now, question, will co-living tenants affect the property valuation since most banks don't support loan for co-living? Okay. Correct me if I misunderstand, but you all let me know. Co-living is renting, right? I don't know whether we need to talk about bank loan. I'm not sure. Are you talking about buying the building to run a co-living business? If that's the case, then very likely the property valuation is a bit different. They might look at it more like a service apartment slash hotel more than like a condominium concept. So the methodologies might be a bit different, FYI. Okay. So question, I thought IRAs have ignored rental of furnishing unit assessment. What does that mean? Okay, IRAS doesn't take into account furnishing. They don't take into account that. But you do know when you submit for lease duty, they will ask you, right, whether or not this is fully furnished, partially furnished, or whatsoever it is, and what's the gross rent you collect, like that. So in a way, they will compare it to the annual value. Annual value is like as if the unit is vacant, compared to the actual rent, which is your gross rent, which might include furnishing. Okay. So hopefully this is clear, all right, for us first. So this is annual value. And normally, if you're talking about the common types of things out there, like condominium, HDB flat, even some of the very similar sort of landed property, even sometimes shop houses, if there are enough comparable data, they will be using comparison method. So the methodologies, hang on to that for a while. We will look at it later on. Now, other than that, just a fun fact for everybody. Now, times IRAs also deal with vacant land. So if we do have vacant land in Singapore, they might determine based on this regulation. So there is this thing called the Property Tax Act that allows the chief assessor empower them to make a assumption that the annual value for vacant land, since maybe you don't have comparable, right, will be based on 5% of whatever is the capital value. So this is just a fun fact for you if you are talking about empty land. Okay. So contribution, empty land tax is higher than vacant land. Empty land tax. Tell me, so what do you mean? Empty land is higher than vacant land. What does vacant unit? Uh, likely, vacant unit. Yeah, likely. Realistically, if you look at the figures and the lump sum, very likely. Okay. So this is one. Now here comes the tax rates. All right. But anyway, I don't think that's very important for us. Most importantly, I will have to say, direct our clients and do it together with our clients. If they want to understand more about property tax, get them to go and use the IRAS calculator. That would be the best way for us to address such questions. But if really they want to know more in-depth stuff about valuation, my suggestion is don't give too much info unless you have a appraiser license. Otherwise, our job is to make sure that we recommend to professional advice. Okay, so this is one. Now, other than that, SLA. So sometimes SLA also deal with things like land acquisition. So land acquisition, there is this component of compensation. We might ask how this compensation work. It's based on valuation. But there's something interesting here for us. Look at this little article here. It says here, let's say they are compensating or deriving at a compensation for this particular landed property that is gazetted for land acquisition. You might see how come a lot of complaint on the ground is that the compensation is very low. That's what some people say. Why is it like that? It could be because whatever comparable they are using is all affected by the road line plan. So that means that it's all already negatively impacted. The value of that location, that vicinity, nearby vicinity, is already impacted negatively. So when they use and compare a unit that is already affected, obviously then the whole area, the whole locality is going to be affected negatively as well. Now, this is one example how statutory restrictions can sometimes affect your valuation. And I'm saying it is, in practical terms, likely negatively. Outline plan is a government, uh, in a way, gazette, right? It's a drawing that tells us certain area are earmarked for road widening works. That sort of thing has got restriction, right, in a way. So because it is earmarked for road widening, then you do know that soon this land acquisition will come. So those kind of things are just examples for you, whereby you have got your statutory restrictions like this one. Okay. Now, sidetrack a bit. So how come residential occupier tax rate so wide difference? Standard is 4% for owner occupied. In fact, it starts with zero. Starts with zero. There are some concession one. The first, if I'm not wrong, I think it's first $28,000 is going to be no need to pay concession. Then I think something like the next $10,000, they will start with 4%. And then progressively it increases all the way until 32%. So there is a big table actually on IRAS's website. In a way, I think the direction is quite clear. The more expensive properties is subjected to lesser concession in a nutshell. So the higher is your annual value, which is likely more expensive the property, the higher is going to be your tax rates. Okay, so the highest level of tax rates, you will see that is almost equivalent to the non-owner occupier rates. Okay, so non-owner occupier rates, if I'm not wrong, starts at uh I think 10 something percent, ends at 36% highest, something along that line. Okay. So this is the reason why lah. This is the table from IRAS. Now, other than that, um, land betterment charge is something that maybe is quite recent occurrence. In case we don't know, but last time we refer to these as development charge and this differential premium. Now no more these two things already. It has been combined into this thing called land betterment charge. We may or may not be dealing with this as agent, but yes, sometimes if you deal with rather unique property, maybe non-residential property, or maybe even for the developers, or on block deals, then yes, we might need to talk a bit more about land betterment charge. But in a nutshell, you need to pay this tax to SLA today if you're going to be making some changes to your title. So example, maybe last time master plan, 2019, the plot ratio for this piece of land, let's say it's owned by a big investor, is 1.8. Now, with the revision 2025, plot ratio becomes 3.0. Do you know you cannot just tear down like that and then rebuild immediately into a higher, bigger building? So normally what will follow will be building plan, right? So if the landowner wants to do some changes, they need to submit the building plan to the necessary authority. Before they can get all the written permission and all these things, they need to pay this tax first. Because effectively, you're changing the existing title into a new, something about something new inserted into your title, which usually will reflect in an enhancement of land value because of the increased density, etc. Sometimes it can also result because of a change of use. So some change of use, if it results in a higher value, like land value, that's when land betterment charge might be payable. So valuation is going to be determining how much land betterment charge is paid. So this is because IRAS have this table called the land betterment charge table of rates. It's going to be determined based on valuation. So this table is not static. It changes every 6 months, 1st March and 1st September. So those kind of things can actually help tell us whether the launches in the future will be more expensive or cheaper. What I meant is this. Usually, especially when you talk about en bloc, especially, GLS, like government land sale, they already cost in this as part of the tender. So usually you don't see that as a separate component. But if it is en bloc, for example, you got your land value that you purchase from the collective owners, right? Then you got to submit your revised plan to the authorities for approval. They will charge this thing called land betterment charge, equals to your land price. So you all know land price is the basis of everything else, right? On top of that, then you add in all other cost, becomes your launch price. So it's quite safe to say if our land betterment charge has been increasing, which it is because market situation is doing quite well right now. So if it is increasing, your land price will increase. This one likely continue to increase, right? Even if it is stagnant, this one increase. So land price increase, launch price will definitely increase as well. This is indirect relationship. So your launch price is indirectly going to be influenced by your valuation, this back end stuff. But yeah, maybe not directly, but these are some things that surely has to be taken into account, especially we are on the developer's point of view, for example, to do things like pricing of the units and things like that. Okay. So land betterment charge, yes, is one of them as well. Mm, question. So it will result in a lower price as you compare to remnant land. So when you buy land, you are using for residential. But when you sell the land to SLA under road, it is road usage, which will be lower than your residential use. And maybe. So at the end of the day, the comparison behind how the compensation is cost in as to your compulsory land acquisition, they take into account many complex layers. Because you are right, you are so-called sell in a way being compensated for residential land, right? May not always be so. Because IRAS might take into account that is going to be the road next time. So the value will be impacted because of different complex levels like this. Correct. So is the table of rates published publicly every 1st March and 1st September? Yes, yes. Okay. If I'm not wrong, I don't know whether URA still have it or not, but definitely SLA. But used to be we look at the development charge table of rates. That one was URA. Now they consolidate everything, become SLA. Okay. So this is it? URA space. Okay, so it's still in URA, is it? So why are developers able to set valuation in a way? Okay, why are developers able to set valuation? This one is a very complex situation, right? For one, they will also work very closely with the banks because banks will finance all the development work, right? Most of the time. So therefore, banks will have to back up whatever is the asking price of the developer. In a nutshell, it's like that. So I'm not surprised if you use the word developers are setting the valuation. Technically, not very correct. Like they don't really set the valuation, but in a way, they have very, very big influence on what is deemed as valuation. Because normally banks will back up whatever is the asking price in order to justify the loan, right? That is the thing. Okay. So there is a case where client had to resell much lower because valuation couldn't even meet launch price possible. Not ideal, but yeah, maybe. Okay. So this is land betterment charge. When is it payable, etc. So normally we're talking about development works or redevelopment works. You need to talk about land betterment charge. But the smaller scale ones might be, example, if you have a owner who wants to install an additional fixed canopy on their PES, for example, or maybe the private roof terrace, those kind of permanent installation also will attract land betterment charge. So usually it's not a big amount. That's why maybe most people don't really talk about that. But yes, this is actually derived from land betterment charge, even for those kind of uh, A&A works like that. Okay. Now here goes. This is your second quiz, but let's do it this way because I'm gonna get you off to break also. So can we maybe give you instead of a 15 minutes break, we give you a 20 minutes break. But within these 20 minutes, you're supposed to finish up the quiz, can? All right. So now it's about 3:30. So let's not take too long. I'm gonna check back with you 3:45, making sure your cameras are on back again. And from 3:45 onwards until 3:50, you will have to complete your quiz. So maybe take a bit of your break time to do up the quiz as well. Okay. Hopefully this sounds good so far, huh? So let me know, but you can start to go for break already. I am going to load up your quiz link right now. Okay, so here you go. It's already on your chat. Okay, so go for a break. Let's come back. I'm gonna check back on you 3:45, and then let's see what's the progress of our submission. We trying to end off earlier today, so y'all quickly submit. Okay, so I'll see you back here 3:45. Okay, everybody, welcome back. I hope everybody is back from the breaks already. So as of now, I have about 370 responses already. So let's just keep the quiz open for another 5 minutes, get all your answers in already, and then we can move on to cover up the rest of the uh things. All right. So 5 minutes. All right, let's get all your submissions in as soon as you can. Okay, let's come back. Thank you for all your submissions. Those of you who are still doing, then just keep that open and then submit whenever you're ready. But I think we're quite happy with the response. As you can see, the median points is quite consistently good. All right, so that's great. I think most of us are fine. Let's just run through some of the main points to learn from this interactive quiz here. Firstly, let's always remember whenever we talk about loan financing, it's always going to be whichever is lower, right? That one you can see very obviously because that's something that you will immediately be able to tell that your loan amount is lesser or maybe CPF withdrawal is capped. That might be more easily seen. But yeah, there's some discussion online earlier about like buyer stamp duty, etc. Whenever we talk about tax, not just stamp duty, any sorts of taxation, that includes lease duty, by the way, it's going to be the other way around, right? Now, this one is actually the law. Lah. So basically, we are citing the Stamp Duties Act, Property Tax Act, etc. that actually empower the IRAS, lah, the controller of tax, to basically collect higher, whichever is higher. If it's valuation versus purchase price or rent, whichever is higher. But I do know some of your concern is normally stamp duty, yes, on our part, we do the estimation, right? So that your clients prepare for the amount. But finally, it will be the lawyers who will be counting this number and to help to make the necessary withdrawal and things like that. But you see, sometimes I'm guessing lah. Sometimes, let's say it is a little bit, deviating between price and valuation. Maybe I'm not sure IRAS might let it go, but at the end of the day, the law is quite clear. They are empowered to basically call for short payment. They have the rights to charge whichever is higher. So whether or not that actually is commonly scrutinized on the ground, to what extent, that is something I don't know. Maybe you can share with me whether or not you do see that being 100% complying or not. But for sure, what we know is that this is what the law says. So for sure, this is something that we have to represent correctly to your clients as well. Okay, so this is one. Now, other than that, I think we are quite okay with valuation, what it affects, and things like that. Earlier, a general question also. This statement it says, which is a false statement about valuation, and that valuation does not affect lease duty, that is a false statement because in fact it does. Because lease duty also, I understand when we submit for stamping, right? You just key in the amount and then you just pay the amount, isn't it? So it does seems that always is on rent, full stop. But again, IRAS behind the scenes, if they do things like auditing, maybe if they check through, they do have the rights to charge whichever is higher, especially so if the valuation versus rent is drastically different. Okay, so this is, I would say, an empowerment, definitely in the point of view for IRAS. Okay, now with this, I think this is our base work. The next thing, what we are going to go on to talk a little bit more on is the methodologies. But this one here, I'm not going to go too technical because I really don't want to misrepresent to you, whereby thinking that we have the rights to do valuation. So once more, a disclaimer to start off with is this. Running through this methodology is not asking you to do valuation. So unless you have an appraisal license, please don't. Our job is to make sure that we recommend to the expert for, point on advice, not us coming up with the valuation figures. But I'm second guessing, running through some methodologies and techniques, at least you get a feel what goes through some of the behind the scenes. Hopefully, this one enriches our knowledge. Okay, so this is going to be the disclaimer I want to have for you first. So there are basically four types, and you can see that these methodologies are actually quite used internationally as well. So some are more common in some countries compared to others, but I have to say this is not unique only to Singapore. One of the most common ones that we see, and I guess we are very used to, is definitely this thing called the comparison method. So I'm going to spend most time on that, but as promised, we will run through everything and let you know what kind of properties or what types of valuation likely the valuers might choose to use which kind of methods. So comparison method sounds like this. This is based on the concept of substitution. So what we're looking at is how much would one person likely pay for? It could be like purchase price or rent for a similar property. So in order for us to use comparison method, the base work is very important, meaning we should only use comparison method when you have a lot of comparable and that it is easy to obtain such data. Ideally, it's going to be sounding something like this. Our subject property is the property that is subjected to valuation. We're going to compare this to the comparable data. And the next thing is to make adjustment according to the differences. Hopefully, this is going to help reflect the estimated value of the subject property. So this is very common. And I will have to say, if you are well versed in doing things like HDB, condominium, sometimes even landed offices, etc., as long as we have a lot of comparable data, ideally, they will always like to use comparison method. And may I say this also right at the very beginning? Even for IRAS, if they can, they will like to use comparison method. For one good reason, because this is the method that is based on past data. Can I use the word past real data? Meaning these are actually really transacted price. These are really what people, willing buyer, willing seller, were willing to transact at. So there is a very strong evidence, there is very strong base to make the assumption based on. Compared to other methodologies you see later, a bit more subjective. But nevertheless, remember when we first started this topic, we talked about valuation, sometimes being subjective. So meaning, IRA's valuer do the valuation, they come out with one result. The banks might come up with another one. A private appraiser might come up with another figure. Does it make it wrong? Valuation is not wrong unless the calculation is wrong. But other than that, you will see why there is subjectivity is because we have to make the adjustments. These adjustments is the one that might make it subjective. Same goes for us. If you want to price the product, you want to price your unit, it's also quite subjective, right? So in a way, we are based on past transaction data. But are you sure we're not going to add in something, deduct some things, etc., and finally listing up the selling price? Question mark. It's also subjective. So maybe agent A will think that okay, this is should be 500K can sell. The other one says should be 600K can sell. It's slightly subjective because of the difference that we need to adjust for. So it's going to sound something like this. You need to have comparable data first. So example, if let's say this is my subject property, I'm trying to value this condo, for example, in 3 residences. This is, the details of the property. Am I going to be comparing it to something in Balestier? Question mark. A bit far, right? Firstly, location is very important because for us, you all know, real property is always about location, 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 right? So things like whether you got, same amenity, you're enjoying the same things or not, years of completion, tenure, things like this is definitely going to make a difference. So I have to say, if you're going to compare to something that is very far-fetched, that is not a good comparison data. So the truth is, the step one, if you want to go step by step, likely valuers as well. They're going to gather comparable data from verified sources, such as through caveats lodged. Or maybe some of the developer new launches, for example, which are captured on URA's database. So the idea here is this. In order to make sense of comparison method, we want to firstly obtain data that is as close as possible to our subject property. So meaning, if you are trying to value a 2-bedroom unit, you should try your best to keep the comparison to other similar 2 bedrooms. If you want to be valuing a high level unit, like maybe on level 20, as much as possible, I want to compare it to similarly higher story units so that the less subjective the final figure will be. Because we are not going to try our best, try to make as little as adjustments as possible to keep the final value more controlled and accurate. So typically, some of y'all were asking me this question earlier, right? Let's say I have a few transaction data. One of them says 500K. Another one says 300K. Another one says 550K. And then maybe you have another one that is $1 million. Another one that is maybe $1.2 million, maybe just some outliners. The general understanding is this: do they take the average? Unlikely, but they are going to look at what is the median. So what forms majority of the transaction? So earlier, one of y'all asked this question, right? Would annual value be affected if you have got two particular units that are rented exceptionally high to special category of tenants, for example? Again, if you out of 200 unit, only two exceptionally high, that will not be reflected in your valuation. But however, out of 200 unit, you got 180 units, they are all that high, then yeah, definitely they're going to take into account that. So why so? We are looking at what is at the middle, those transactions that are in the middle ground, because we won't know what is actually happening on the ground. Because like some of y'all said, sometimes it might be a sale within family, sometimes it could be a personal transaction that the prices are exceptionally low. We're going to disregard all these things. So exceptionally high or exceptionally low prices, rent, etc., may be telltale signs that these are not transacted at arm's length and therefore usually will be discarded. So we won't take that into account because that's not going to be fair. On top of that, usually we also look into details such as we want something that is more recent. So commonly valuers depend on the 3-month time frame to ensure of the recency. Other things, like we said, if this is exceptionally high or low, they're going to exclude that because you don't know. Sometimes it could be not arm's length. Sometimes there are certain payment of a premium because this has nostalgic value to a certain person, could be. So that is how IRAS tries to, sieve out some of the relevant comparable data out of the whole sea of data. So example will be something like this. I want to value this unit. This is my subject property. This is the list that I generated, let's say, from caveats lodged. I'm going to take into account, let's say date of valuation is October. I probably will only look at this one. Not even so much dated. Not only that, the size. This is the best comparable, isn't it? So very likely the value will be very close to whatever we are seeing here. Okay. So in a nutshell, that's how comparison methodologies work. Again, if this is a two-bedder, I will try my best to get comparable data to the same two-bedders. If it is high floor, then you try to get high floor units. That is the best bet you can have. Because you do know, if you are relying on a lot of differences of your comparable data, the more the adjustment that we need to make, then the more unreliable is the final figure. That's going to be the same way for valuation as well. Okay, so typically this is how comparison looks like. Now, of course, the expertise of these appraisers is to be making adjustment for the differences. So example, maybe the comparable, one of them is 1407. The other comparable is on the 8th story. Both of them are road facing, quite similar. They might want to make adjustment based on the height differences. Could be this is how they finally get the valuation, for example. But again, this part is the challenging part. How do you know one story is 5,000? Right? Question. Well, this one, it depends. Banks usually will have their own kind of, benchmark. Like people like HDB will have their own benchmark. IRAS will definitely have their own kind of parameter for the valuers to work around with. So that's something that we won't know unless you're working for the authorities or the respective banks, etc. Okay. So in a nutshell, this is how they try to make up for the differences to try to derive at what would be value. What would be the fair open market value if this is going to be transacted at arm's length. So this is adjustment. Now, the more you adjust, you realize the more unreliable is going to be your end figure. So the end figure may not be the truth because valuation is not looking for the truth. It's not like the law per se. So it is not unusual. Sometimes there is certain subjectivity that is going to skew your figures at the end of the day. which helps us explain how come bank valuer come out different from private valuer. You got en bloc, three of valuer, three valuation report can be drastically different. Why? Of course, there are some justification for the different valuers, but you will see that's why it's so subjective sometimes. The main thing is this, not everything we will be able to use comparable data. Some simply do not have comparison. Some are simply so unique. So therefore, we might need to take into account the different considerations when we are doing adjustments for different types of property. So I'm just going to use the example of retail. Then you will understand how valuation is going to be very drastically different. Let's say for a commercial mall like this compared to a residential unit that we show you earlier. So example, this is Plaza Singapura. Do you want to make a guess? Just talk about the level lah. You got basement one, which is directly connected to MRT. You got level one, you got level two, level three. Let's just, for example, you have these few levels. Which level do you think will have the highest valuation? Question mark. What do you all think? Is it B1, level 2, level 3, or what? Which one will have the highest value? Okay, good. Most of you say level 1 or maybe even B1. Yes, the one that's connected to MRT. Very good. So once again, you see, I'm talking about Plaza Singapura. That's why you are saying, oh, connected to the MRT station. So it's not always absolute. It's not correct to say this. For all retail mall, must be level 1 is the most expensive. Yes and no. Of course, generally we say level 1 where the main entrances are, typically where the traffic foot flow is the highest. Those kind of things will be main consideration as to pricing, as to valuation, which is related to valuation. But you got to take into account, like Plaza Singapura, you got special connection, right? From B1. B1 may be where the most traffic flow is, could be. Vivo City also, maybe, right? Secondly, sometimes you might have unique malls, like for example, Westgate. Westgate, you got the Linkway from the MRT station on level 2, So maybe level 2 might be as high as a valuation as level 1 could be. So it does depend on the, configuration of the malls and the different attributes in place in order to determine valuation per se. So sometimes because of this subjectivity, you might find that it's not going to be very fair to say Plaza Singapura level 1 unit is equals to the value of, let's say, Ion Orchard. A bit difficult to have that sort of comparables, isn't it? So for some of these reasons, especially when you have got, kind of unique malls like this, sometimes they might not use 100% comparison method. They might use a combination of comparison as well as maybe this thing called the profits test method. Could be. Very good contribution from Betty. Also, sometimes you got unique configurations like this one. You see, those with large frontage one, like road frontage, usually those kind of spaces commands premium, right? Now, like Plaza Singapura, it's meant by CapitaLand, the REITs, they're very smart when they're designing the property. In order to increase the valuation of the mall, you got to increase rent, right? So in order for rent to be increased, they try to make a lot of frontage so that they can justify why the rent is higher for this and that, right? So yes, definitely. Those that have got road frontage one, definitely there will be some premium. Okay. So this is one consideration. So you can see that it's very drastically different from the usual, residential properties that we deal with when it comes to different subsegments of properties. Same goes Vivo City also, right? Vivo City have a few entrances, by the way. Yes, the one that is MRT. I think that was B1, right? Or B2. Direct entrance to MRT, those kind of linkway usually is the most traffic flow. But you also have got other entrances whereby the taxi stands are, the bus stops are. And this one is unique because this forms somewhat like a connection to Sentosa. Those kind of things, again, are quite unique. Do you agree? So once again, is it going to be fair that I'm going to value the shop space of Vivo City to maybe Tiong Bahru or the Arc? Not very fair, lah, I think, because of the unique proposition of this building. Okay, so this is one. Now, in that case, how are we going to use rental comparison method, right, to value some of these unique properties like MBS? How to value the hotel room? Am I going to compare to maybe Ritz-Carlton or maybe nearby Marina Square, that hotel, etc.? May not be so fair, right, to use comparison. Same goes, you got jewel. Those are unique properties. How about a museum? Is a museum subject to valuation or not? Yes. Petrol station, yes. Library also. Even things like PSA. One might ask, why do you want to value this kind of thing? I know if you are standing in the shoes of the real estate salesperson, of course, hardly any of us deal with any of this property for sure. But however, why do valuations still, is important for some of this? Number one, for taxation. So IRAS will have to value these unique properties as well. Number two, sometimes for insurance purposes. So example like PSA port. Very likely you're going to have to buy things like fire insurance premium and things like that. Have you ever wondered how this insurer comes up with the sum and then calculate how much is the monthly payment and things like that? Because of valuation. It's actually based or backed by valuation. Now, in such situation, these are what we call unique properties. It's not likely possible you can find comparable, meaningful data. So therefore, when you have special kinds of property like that, you will have to maybe rely on other methodologies. These are the two common ones. Now, the contractors basis method, sometimes in the market, we call this the cost method. Profits test method is known as the income method. So these two are different, but as a disclaimer first, of the two, which one is more preferred? This one, profits test. Contractors basis, actually, out of everything else, you were going to see is actually the most unreliable one. Although unreliable, but some instances you got no choice but to look at the cost in order to derive that valuation. So yes, if the valuers have a other alternative, likely contractors basis will be the last approach. But here goes. This cost method, the assumption is the valuation of whatever is the land or the property is equals to the cost. But this one is actually the least reliable out of all. And we try not to use it unless you have really no other methodologies. There are certain assumptions that we need to make, such as how much is the cost of construction. And worse still, if the cost of construction was 20 years ago, it's not going to be meaningful to look at it now, right? So therefore, these are all the question mark that is present, which might make things a little more subjective. So commonly, when would people use cost method? This is when they are not capable of generating meaningful income or and don't have comparable data. So cost method looks like this: land value first. So land value, maybe sometimes they will use a combination of comparison method to see whether or not we can try to derive at the value of land. But here comes the subjectivity. Value of land plus the cost of improvement, which might be done years ago. Then you got to depreciate the worth of the building, right? Because if that building is already built 20 years ago, if you want the value now, there will be depreciation. The value of the building today is not going to be equals to the value last time when it was first constructed. So therefore, there is a rate that they need to deduct from in order to obtain this thing called the effective capital value. Once again, this is a big question mark. Big question mark. How much is the cost is one thing. Secondly, is how much to deduct as depreciation. A lot of things are assumption, by the way. So again, this is of course up to IRA slightly to determine how much is a worth depreciation. Now with this, IRAs also look at this, use this method. If they're trying to derive an annual value, severely dilapidated land or building. And in order to find the annual value, they assume this is like a vacant land, especially when it's so badly deteriorated, by applying a 5% rate. This is a statutory allowance that allows the chief assessor to do so if they deem fit. Okay, so this is a little bit behind the scene, but just something interesting for you. Now, on top of that, also for purpose of property tax calculation, IRAS also regards all land to be freehold. So they actually don't take into account when it comes to annual value. Remember, it's rent. Whenever they talk about annual value as rent, they take it as everything is freehold. So even if yours is a very old building with a remaining leasehold 20 years, for example, it will still be the same methodologies and the same rates that they're going to be basing on. Okay, so this is cost method. Now, on top of that, maybe more meaningful for you to just have a brief note, what kind of building might cost method be used? They are not income generating and they are quite unique. So like example, some government building like library, sometimes maybe state-run museums, for example, public schools like secondary schools and all this, sometimes your civil buildings such as like CC, community centers and things like that. They might use the cost method. Okay. So place of worship is also one common one that cost methodologies usually are the ones that is being used because you can't, how else can we derive that value, question mark, right? So that's why this method is there. Now, other than that, a more commonly seen method is this thing called the income method. This assumption is this: whatever is the valuation is whatever income that is going to be generated from this building. So this is commonly used for properties that are income generating but doesn't have meaningful comparable data, such as what could be Plaza Singapura could be using part of it is income method, could be MBS for sure is income method. A lot of hotels out there are based on income. But the catch is this, then they must have enough income producing evidence, such as the balance sheet and things like that, to be submitted to IRAS for them to do the valuation. Okay, so usually, if this is like business, it's easy for them to obtain the records, right? Because you have all those tax records, etc., under IRAS as well. So usually they will use this for income generating uh, here. Okay. Now sidetrack a bit. Is there a cost of replacement method? Cost of replacement method, what does that mean? Uh, replacement cost method is equals to how much value equals to if you are going to replace the building. I hope that makes sense. But let me know if I'm misunderstanding the question because I didn't really get that very much. Anyway, let me go on to talk a little bit more about income method. This is just a sample illustration, but we're going to look at things like maybe hotel. Very commonly, hotel uses income method in order to derive at valuation. So they're going to add on all the income minus all the expenses and to come up with this thing called the net operating income. This is the thing that is going to be a little subjective. Capitalization rates means, of course, we need to take away the owner's profit. So the ROI, return on investment, and things like that, which is an assumption. Of course, IRAs have their own parameter to determine how much is that. But with that, overall, if you basically divided by your rate, your value is going to be derived by your net operating income dividing by the cap rate. So this sort of cap rate is also going to be determined by IRAS, obviously, okay? But this is a feel, how it looks like in order to conduct assessment based on income method, okay? Now, question, building that is destroyed by fire, how will the insurance payout be calculated? I think that is a good question. I'm not pro in insurance, but maybe my second guess is this. Firstly, if they will look at the amounts claimed. So normally people will talk about things like whether or not your fire insurance is only for the building or only for and as well as including your personal belonging. So let's just assume this building insurance is only for the building. They might use cost method, cost of replacement, correct, right? So how much was it how much was the cost of building this unit or this house or this building, and to take into account depreciation over the years in order to determine the payout. It does look like likely is going to be cost method, right? So hopefully this one answers your question, but that's a cool question. It spins off our thinking hat. Good one. So this is income method coming back, all right? So income method is very commonly used for buildings with receipts. That means they have their businesses, like they're open for business and things like that. Like resorts, like things like RWS, by the way, like theme parks, they will likely use income method as well. Other things will be like this esplanade, theaters and things like that. Quite commonly, we will use income methods as well. Could be museums, especially if the museums are income generating museums and not state funded. Okay. Yeah, RWS is definitely one. MBS is another very classic example. I'm quite sure this is going to be income method. Now, lastly, maybe something that you might be a bit more interested in because a lot of developers use this one, the residual method. Residual method looks at what is left. So what there is a big sum that this building is worth, and I got to minus off all the other things that are not part of land, ultimately to derive at value of land. So this is kind of working the method backwards. You work backwards. A lot of developers will use this in order to determine how much they want to bid for government land sale, how much they should be paying for the en bloc and things like that. And a lot of time we use residual method for feasibility studies to see whether or not this gets us that return on investment that is satisfactory to the management. So it's quite common. We use this method to derive at land cost. So it sounds something like this. I have to, based on methodologies of valuation again, determine how much is the gross development value. So meaning after this building or project is completed, how much is it likely going to be valued at? Now this one is quite complex because in reality it's going to look at, for example, the selling price after all the units are sold. That's how it looks like. So selling price minus away all the cost of the project, meaning something like construction, minus away things like marketing costs, minus away things like profits, which is your capital rate. Then with that, I work backwards at value of land. This is how residual method works, okay, in a nutshell. So very commonly, this selling price is going to be based on market data. Since you got to work backwards, right? So how do I know how much is the selling price? So it's quite common. Sometimes developers will engage the service of people like you guys, for example, agents or maybe the agencies to give their advice. This location, how much are the competitors selling at? Does that work? What's the absorption rate? How much are we going to be selling at? What's going to be, the foreseeable economic situation that might affect prices? So those are things that they will talk about, obviously, and to discuss. Sometimes the EA will give like a feasibility studies to the developers to help give them advice as well. So it can be you, lah, right? It can be any one of us here. So with this, that's how they work backwards to determine how much they will put in as the tender bid. So this one I know is a big string of number. You don't have to worry about this, but typically this is how, in a nutshell, feasibility studies are counted. So example, architects will inform, example, how many units it will be built to. And with that, maybe average size multiplied by all the gross floor area or the net floor area with whatever is the advice from the EA, we will normally get a gross development value. With this, we got to deduct away all the known costs. These are usually based on the balance sheet contracts and things like that. With this, after you deduct everything else, this is going to be the residue. That means the leftover value. So with this, they work backwards, right? Imagine this is, a gross floor area of this much. You divide by the gross floor area, you get the PSF. This will be ultimately forming your estimated bid price. So this, again, this method maybe, I don't know, maybe agents, you don't really see this, but definitely, in case you're wondering how developers are coming up with the land cost and all that thing, this. All right. So they need to be confident also, right? Whatever they're going to bid to buy the land, ultimately they will be able to find sellers in the market. So how do they determine this? Based on this thing called residual method. Sometimes investors, I'm hearing, also use the residual method. So, for example, you might have a company that invests in properties. So they might want to buy commercial units or shop houses, etc. They might rely on this method in order to derive at how much they should pay for. So how much they want to buy this shop house for, that determination sometimes can come from residual method as well. Okay, so that is the last method. Okay, now with this, very quickly, this is your last quiz. Let's finish this up within the next 10 minutes or so. Now we got more questions, by the way, 10 questions. Let's finish this up in 10 minutes time. Then we run through and recap everything else. We are ready to go and call it a day. Okay, so as usual, please make sure you submit your quizzes. I'm coming out the link right about now. Okay, so here comes. Let's try to get all the submission in within the next 10 minutes. Okay, so I'm gonna leave you for a while. Now 4:30, I'm gonna come and check back on you about 4:40 or 4:35 like that. Let's see what's our progress. And let's wrap up the chapter, hopefully before 5, okay? But yes, admin side might be still taking photo because there are 465 of you. So make sure your cameras are on and continues to be on. Okay, we have about 150 responses as of now already. So let's continue and complete the quizzes and to submit them when you're ready. We're going to close off the quiz in about 5 minutes time. Okay, we have about 340 responses already. As usual, keep it coming. We're closing the quiz segment in about 2 minutes' time. And we're going to go through the answers together and finish up today's section. Okay, and let's come back to go through the answers together. Now, of course, those of you who are still submitting, please get all your submissions in. That's fine. But I think quite happy with the results. I think most of us are okay. I think we are getting in some of the absorptions already. So that's great. Okay. Now, valuation is always going to be, can be done, even if it is a burned down house, for example, vacant house, dilapidated state, etc. So those things are all, possible for us to derive with valuation, just using different methodologies, basically. All right. Now, other things, maybe this part I should go through slightly because not everybody got it right. But this one is just a statutory law, lah, right? That IRA's chief assessor actually determine that vacant land or sometimes severely dilapidated buildings based on 5% of capital value if they are interested to find out what would be rent, which is annual value. So 5% is the right answer. Okay. Now, other than that, I think we are all okay here. So I don't think we're going to spend too much time talking about this much further. But of course, let me know if we have got specific questions. We'll be happy to take them. Now, one thing that I think we should go through here because some of us didn't get it quite right. So, which is a false statement, right? Comparison method usually is not used for hotels, by the way. Okay, so this is a false method. The other things such as comparison method is highly reliant on comparable data. So in order to use that method, you must be able to get recent comparable data. And yes, most of the properties that we're dealing with, it's all using comparison method actually, based on things like URA captured data. Okay. Other than that, let's also look through this. Now, cost method, all right, is the one that takes into account depreciation of the buildings, etc. All right. The rest, not that correct. Let's go through everything part by part. Now, profits test method can only be used if there is sufficient income data, to be fair. All right. This is one. Now, residual method is not only used for vacant land, to be precise. It can be used, like I said, for investors. Sometimes they want to purchase a shop house. They might use residual method in order to determine how much is the offer that they decide to put in. Okay. So other than that, I think we are quite okay with the rest. So I'm quite happy with the progress so far. Okay. Now let me check and see whether or not there are questions. Okay, question. So question on HDB valuation. So for some reason, valuer not able to enter the unit to evaluate the unit, what will happen? So far, what I'm hearing from the market, you let me know if you understand it differently. HDB valuers may not always visit the units, right? I'm not sure whether my understanding is correct, but maybe they don't always visit the unit. So they might be basing this purely based on paper evidence. So meaning like the data, comparable data from URA. And if they feel like this is good enough to derive at a valuation, they may not always visit the unit law. So yeah, I'm hearing from the market, not all the time. Sometimes they do, sometimes they don't. So they might likely be basing just based on paper data. That's all. But if you ask me, theoretically lah, because I graduated from real estate, so every time when we do valuation modules, it's always the technical right way to do is to always go for site assessment, especially when these are quite unique properties, because without going to the site, without seeing the actual condition, there might be some unfairness like in the value. So that's my little experience that I can share with you. Now, other questions, let me see. So even if we have private valuation, but if the bank indication don't meet the private valuer, we still unable to use private valuation, correct? Because banks will determine their risk based on their own valuation. So why would you engage private valuers? As a benchmark, I think it's better than nothing. It's a benchmark, but I will have to say it is important to also deal with the bank's valuers. So especially if you have got things like, for example, property developer, because they are taking loan and huge amounts of loan for their construction and things like that. So it's not uncommon. They have their own private valuer and the bank's valuer. In case the bank valuation for some reason cannot meet, then maybe the valuers might have a discussion to come to some sort of a middle point. It could be that can be one way how your valuation, private valuation reports can be helpful. Okay, so hopefully this one addresses some of your concerns. But I'm gonna also wrap up this section here this afternoon by running through something that is closer to our hearts. We all know valuation is a very technical topic. No choice, we have to do that because that one is going to affect price, going to affect your sentiments of your clients, for example. But I have to say, valuation is may not always be equal to price. What we are very used to dealing with is price. Do you agree? We're not that well versed in dealing with valuation, but we are very good at dealing with price. Price has got to do with sometimes future, sometimes potential, right? So how much your client willing to pay or not, sometimes it might be because they see a certain potential. That is the thing. So therefore, if you want to talk about valuation, valuation is based on past transaction. So meaning it is going to be based on the past numbers, past prices, may not be reflective of future investment value. This is one. Secondly, it may not be able to catch up with the market, especially if we are looking at a bull's market. So like these few years, why you got so much COV? Because these few years, the market, property market, has been quite rapidly rising, isn't it? So we are looking at already about what, 20-30% gain, 40% gain already. So with that, if the market is that robust and is really in a bull's run, you might have a situation whereby valuation is always backdating. But whatever we are looking at today as selling price or asking price is very much forward looking, you see. So that's the disparity. And that's the struggle between, value and actual price, right? So that is one of the thing that we need to take into account. Now, hopefully you can also, I don't know whether or not it will be helpful for you to justify to your respective clients why, sometimes valuation is different from the price like that. How can you advise me to offer this amount and then later on valuation comes in different thing like that? Could be. So this is one. Now with this, what we are looking at is just a simple chart from URA, right? You all know. We're saying the actual asking price might be higher than valuation, especially when it is in a bull's run. Therefore, these few years you see a lot of COV transaction. But when market situation is not so good, market is coming down already, your valuation end up higher than the price because your valuation is backdating, you see. So that is the lagged effect, if you ask me. So valuation has a little bit of a lag effect because we are looking at past transaction. Okay. So in a downward market, you might have a situation whereby the asking price may be just nice valuation or maybe even sometimes lower than valuation. Okay, so this is what we can see in the market. Always there is going to be a disparity between current demand, current supply, and in a way backdated valuation. Valuation is always based on past transaction, past data, which might rapidly change because of maybe external forces. Example, today regulation suddenly announced a big change. Suddenly today they say everybody no need to pay ABSD. Guess what? Of course, demand is going to shoot up, right? And when that happened, obviously it's going to be much higher than whatever was the so-called valuation when ABSD was still there, isn't it? So therefore, it is going to be subjected to, different considerations that might occur, that might cause a push-pull effect, right? On price, valuation, etc. So at the nutshell, price is going to be determined in a way is somewhat like a forecast. Price is looks like a forecast, right? A bit like looking at what is the upcoming supply, what is going to happen in the economic side of things upcoming and things like that. So therefore, when you talk about developers pricing, let's not forget developer also are more interested in price. But we cannot get away from valuation because we need valuation to support in a way so that you can get your loan and things like that. Now, price itself is going to be determined by two major things, right? Supply in the pipeline, competitors, and things like that, and as well as demand. Now, demand will have to look at things like, for example, sometimes even macroeconomics. I don't know. Increasingly, there are more and more talks about, war and things like that. Could that have some effects on jobs? Could that have some effects on demand? Definitely very close to our shores is our newest US tariff hikes, isn't it? Those kind of things is going to affect our GDP and things like that. Those things, would it have some effects on demand or not? Question mark. So yes, definitely there will be. I mentioned about government intervention, like, canceling certain regulation, immediately there'll be a knee-jerk reaction. Or today, maybe they increase ABSD again, then there will be knee-jerk reaction, which you will see is going to be immediately affecting price. So price is going to be the one that will be the first to be affected. Down market, up market, price is the first thing to be affected. Then it will have the trigger effect on valuation. So although we always use valuation as a benchmark, but it does depends. For example, if you're going to be pricing a unit today we are still quite a robust market. So I'm not surprised if your client is not happy if you tell them, this is the valuation for the last few transactions. We should price around this range. To them, they might find that, but everybody is asking for higher and higher. I should try more than valuation, right? Could be. So that can be the struggle that we might face on the ground. So again, hopefully with this sort of, and understanding, we can help to justify why we are recommending this and that to your clients behind the scenes. So I have to say, normally you commonly see COV, right? When it is a robust market in an upcycle. A general understanding is also this: whatever past valuation we are depending on is just a benchmark for us to understand what used to be and what might likely be, but it's not an actual valuation. Even if you tell me you hire a private valuer, also same thing, valuer is also going to be dependent on whatever was the past transaction. So valuation is not equal to price. Price is going to be a much complex segment, because it's going to be a lot more fluid and going to be affected based on immediate demand and supply as well. So likely, I would say, especially if you're dealing with HDB, it's good lah to always have a few scenario plans to at least, represent properly to your client. There is a possibility of COV today, possible, especially now. And of course, I think more relevant to us is to understand, despite we say price is one thing, valuation is still important, because those things will help affect all the technical things that you need, such as mortgage, taxation, and things like that. So, especially when you are dealing with HDB, because the valuation report will come in after OTP is issued, it makes sense for us to do financial estimation again, especially when there is COV and things like that. So this is my last little parting note for you. Okay. So anyway, yeah, this is what we have for you this day. All right. Hopefully you found that useful. But with that, I'm not really done yet. I'm going to go on to take some Q&A, but Annie, if you need to, you can take over the screen for the necessary attendance and admin side of things. Okay. So I'm going to stop sharing for a while so that we can take over this screen. Okay, I'm going to be taking some questions as we are speaking. First question first. So HDB, we are unable to determine what is the true valuation as the data of COV has been excluded, correct? So is there any way we are able to find the actual valuation for HDB? I think these days, your EAs and things like that, when they give us data, sometimes we might be able to see valuation, but not every transaction will have that figure. So unfortunately, I can't say there is a foolproof way how to find valuation. But you see, the past valuation may not be relevant today already, especially where a lot of units have got COV, because today's value should take into account past transaction data, not past valuation. So actually, it's better, and I think it's more accurate if we are going to be depending on past transaction data instead of past valuation. Hopefully that makes sense. Let me know if you agree or disagree with me. Okay. So another question. So if the unit transacts as $1.2 million, how do we know the valuation versus the transaction? Correct, lor. So we might not always know that. But what's more important is the past transaction to me. If you want to do pricing, what is more important is the past transaction, particularly. Okay. So question, would bank's valuer for a shop house usually be higher than a private valuation? Mm, may or may not be. May or may not be. Okay, example, one shop house was given bank indicative value at 10 million, whereas the private valuer 9 million. So how can you explain that to the buyer? Okay, so hopefully the private valuer is hired by the seller. Like, I'm assuming that. So to me, I will make it known to the buyer what's more important is the bank's valuation. Because bank valuation will determine your loan amount, which is good if your bank valuers are higher. Because next time when you sell the property, then very likely the valuation will also be higher, right? And the bank's portion is more important because that will determine all the mortgage and things like that. Okay. But let me know if I'm missing anything because you all know a lot of things and the chat is running really, really fast. Okay. But I think I shouldn't have missed out anything, but let me know, all right, if I did miss out anything. Okay. But end of the day, I hope we learned something. Keep it in your pocket. At least we have some deeper knowledge about the topic on valuation. More importantly, is to tell that this is different from pricing. Hopefully, that can help us, form some explanation to your clients on the ground as to why it is different, how come got COV and things like that. Okay. So thank you very much for all your support. Okay. So it's okay. All right. Keep the questions coming if you have. But otherwise, yes, this is your feedback form on the screen. Please complete that. Okay. Now, as the last statement for me this afternoon, some of us are done for the day, then good for you. Have a good weekend ahead. Those of you who are going to continue on for tonight's session, I'll see you back here at 7. Have a good dinner ahead then. Okay. So Annie, if you have any other things else, then over to you.
All right, thank you, Cheryl. Everybody, please submit your feedback form. Yeah, after that, you can exit the Zoom already. Thank you.